Have you ever stared at your phone, opened a brokerage app, and just frozen? Index funds, ETFs, mutual funds, hedge funds, everyone's throwing these terms around like it's common knowledge, but nobody actually takes the time to explain what they mean, or more importantly, what the difference is for someone like you. Here's something that might surprise you. Most Americans who are actively saving money have no idea which type of fund they're actually invested in right now. They just clicked recommended and hoped for the best. And look, that might be fine, or it might be quietly costing you thousands of dollars over the next decade. In the next 6 minutes, I'm going to break down every major type of investment fund in plain English. No jargon, no fluff. By the end of this video, you'll know exactly which one fits your situation. Let's get into it.
Before we compare the different types, we need to understand what a fund actually is at its core, because this is where most explanations get unnecessarily complicated. Picture this. You and 5 coworkers all want to grab a birthday cake for a colleague. Nobody wants to shell out $60 alone, so you each chip in $10. Now you've pooled your money, and you get a much better cake than any of you could have bought individually. That's a fund. In its most basic form, a group of people contribute money together, and that combined capital gets invested across a range of assets. Stocks, bonds, real estate, and more. You don't manage each investment yourself. The fund does it for you, and you earn a proportional share of whatever it returns. If you're like most Americans, you've probably been told to invest for retirement, without anyone explaining exactly how the vehicle you're investing through actually works. This is the exact gap we're filling today. Now, not all funds are built the same. They differ wildly in cost, strategy, and risk. Let's walk through each one.
Section A, Index Funds. The set it and breathe option. Let's start with index funds, because these are probably what your financially savvy friend keeps telling you to put your money into. An index fund doesn't try to beat the market. It is the market, or at least a specific slice of it. It works by mirroring an index, which is essentially a curated list of companies representing a particular segment of the economy. Take the S&P 500. That index tracks 500 of America's largest publicly traded companies, the Amazons, the Apples, the Berkshire Hathaways of the world. An index fund that tracks the S&P 500 buys tiny pieces of all 500 of those companies at once. You're not betting on one winner. You're betting on the broader American economy. There are also specialized index options. The Russell 2000 tracks smaller, growth-oriented U.S. companies. The MSCI EFA covers international developed markets. Think Germany, Japan, Australia. And the Bloomberg U.S. Aggregate Bond Index tracks the bond market for more conservative investors. Because index funds are passively managed, meaning no expensive team of analysts is picking stocks, they cost almost nothing to run. The annual fee, called an expense ratio, typically runs between 0.03% and 0.20%. On a $5,000 investment, that's between $1.50 and $10 per year. Real talk. The fee drag problem most people ignore. The mistake most people make right here is underestimating how fees compound over time. A 1% annual fee on a $25,000 portfolio doesn't sound like much, but over 30 years at a 7% annual return, that 1% difference costs you over $57,000 in lost growth. Index funds sidestep this almost entirely. One important mechanic to understand: unlike stocks, index funds are only priced once per day, after the market closes at 4 p.m. Eastern. Whatever price is calculated at that closing bell is what you get,
regardless of when during the day you place your order. This is called the net asset value, or NAV. For long-term investors, this almost never matters. But if you're expecting to trade like a day trader, index funds aren't your vehicle. Notable index fund providers include Vanguard, VOO for the S&P 500 index, BND for total bond market, Charles Schwab, SWTSX for total US market, and Fidelity, FZROXO, which actually charges 0 fees at all. Section B, mutual funds, the trust the expert option. Mutual funds may look a lot like index funds on the surface. Both pool investor money, both spread it across multiple assets, but the key difference is who's making the calls. Mutual funds are actively managed. That means a professional portfolio manager, or an entire team, is constantly analyzing the market, making trades, and trying to outperform a benchmark, like the S&P 500. The pitch is compelling. You're paying for human expertise and judgment. The reality? The data isn't kind. According to the SPIVA, S&P Indices versus Active Report, roughly 90% of actively managed large-cap U.S. mutual funds underperform the S&P 500 over a 15-year period.
after fees. The pitfall: paying more to earn less. Mutual fund expense ratios typically range from 0.5% to 1.5% annually, sometimes higher with load fees, sales commissions, layered on top. This is where I used to fail constantly in my thinking. I assumed higher fees meant better performance. They usually don't. That said, mutual funds aren't without merit. Some fund managers do beat the market in specific sectors or market conditions, particularly in less efficient markets like small-cap international stocks or emerging economies, where index funds have less coverage. And similar to index funds, mutual fund trades also settle once daily at the NAV price. Major mutual fund providers include T. Rowe Price, known for strong, growth-oriented strategies, American Funds, part of Capital Group, popular in employer-sponsored 401k plans, and Dodge & Cox, a well-regarded value-focused manager. Always verify whether a fund is actively or passively managed before investing. The label alone won't tell you.
Section C, Hedge Funds, the Wall Street Insider's option. Now we're entering different territory entirely. Hedge funds operate in a world most of us will never access, and that's by design. They're private investment vehicles that pool capital from ultra-high net worth individuals and institutions like university endowments or pension funds. To participate, you typically need to qualify as an accredited investor, which the SEC defines as having a net worth of over $1 million, excluding your primary home, or annual income exceeding $200,000. What makes hedge funds distinctive is the range of aggressive strategies they can deploy: short selling, profiting when stocks fall, leverage, borrowing capital to amplify bets, derivatives like options and futures, arbitrage across global markets. The freedom is enormous, and so is the risk. Fee structure, the famous 2 and 20 model. Hedge funds typically charge a 2% annual management fee on total assets, plus 20% of any profits generated. To illustrate, invest $500,000, earn a 15% return, $75,000, and you'd pay $10,000 in management fees plus $15,000 in performance fees, a combined $25,000 just in costs. That's why hedge funds must generate exceptional returns to justify their existence. Some of the world's most recognized hedge funds, Bridgewater Associates, Citadel, Renaissance Technologies, have produced extraordinary long-term returns.
But they've also experienced some spectacular blow-ups. For the average American investor watching this video, hedge funds are informational context, not a near-term destination. Section D, ETFs, the best of both worlds option. ETFs, exchange-traded funds, are where flexibility meets diversification, and they've become one of the fastest-growing investment products in U.S. financial markets over the last decade. Here's the simplest way to think about it. An ETF is like a mutual fund that trades like a stock. Unlike index funds or mutual funds, which settle once per day after market close, ETFs trade in real time on stock exchanges throughout the trading day. You can buy an ETF at 10:15 a.m., watch the price move for 3 hours, and sell at 1:30 p.m. if you choose. The price fluctuates continuously based on supply and demand. Most ETFs track an index passively, keeping costs low. Typical expense ratios range from 0.03% to 0.75%. But the ETF universe has expanded dramatically. Today, you can find ETFs that cover everything from the total U.S. stock market to clean energy companies to dividend-focused strategies to inverse ETFs that actually profit when markets decline. ETF Spotlight, popular ETFs on Vanguard and Charles Schwab. VOO, Vanguard S&P 500 ETF. Expense ratio 0.03%. Tracks 500 largest U.S. companies. SCHD, Schwab U.S. Dividend Equity ETF. Expense ratio 0.06%. Focuses on high-quality dividend payers. VTI, Vanguard Total Stock Market ETF. Expense ratio 0.03%.
Covers the entire U.S. stock market ETF. Expense ratio 0.03%. Nearly 2,500 U.S. stocks in one fund. Another key advantage: tax efficiency. Because ETFs rarely generate internal capital gains distributions, a quirk of how they're structured, they tend to create fewer taxable events for investors in taxable brokerage accounts. If you're investing outside of a 401k or IRA, this matters more than most people realize. Now, here's the part I want you to actually take with you. Let me show you 2 real-world scenarios, fictionalized but completely realistic, that illustrate exactly how much these choices matter. Investor A, Marcus, the high fee trap. Marcus is 30 years old. He opens an investment account and puts in $2,500, then adds $200 per month. His financial advisor recommends an actively managed mutual fund with a 1.2% annual expense ratio.
Over 30 years, assuming 7% average annual market growth, Marcus ends up with approximately $236,000. Investor B, Diana, the low-cost index strategy. Diana's also 30. Same $2,500 starting amount, same $200 per month contribution, but she invests in VOO, Vanguard's S&P 500 ETF, at a 0.03% expense ratio, same 7% growth assumption. Over 30 years, Diana ends up with approximately $279,000. Same starting point, same contributions, same market performance. The only difference? Fees. And Diana walks away with roughly $43,000 more just from paying attention to expense ratios. Imagine finally having that kind of clarity over something you've always treated as background noise. That's what understanding your investment vehicle actually does for you.
Now, zoom out even further. What if you're 25 instead of 30, and you had 35 years instead of 30? That $43,000 gap grows to over $80,000. The math always compounds in favor of the person who paid attention to costs early. This is the mistake most people make right here. They focus exclusively on returns and ignore fees, trading flexibility, and tax implications. The fund with the flashiest performance number isn't always the fund building the most wealth.
All right, let's land the plane. Here's your quick reference breakdown of everything we covered. Here's the actionable path forward starting today. If you're just starting out, open a Roth IRA or brokerage account and start with a low-cost ETF like VOO or VTI. Keep it simple. Time in the market beats timing the market every time. If you have an existing 401k, log in and check your fund's expense ratio right now. If it's above 0.5% and no one can explain why you're in that fund, it's time to ask questions. If you're already investing, run a quick comparison. What would your balance look like with 0.5% lower annual fees over the next 20 years? The answer will either reassure you or motivate you. If someone ever pitches you a hedge fund, know that the barrier to entry exists for a reason. Unless you're an accredited investor with risk capital to spare, you have better tools available right now. The financial industry profits from confusion. The moment you understand the difference between these four fund types, the costs, the mechanics, the right context for each, you stop being a passive bystander in your own financial story. You've got the tools. Now it's time to build your financial future. If this video helped you, do me a favor and hit that subscribe button. I break down one financial concept every week in exactly this way. No fluff, no jargon, just the stuff that actually matters for your money. Drop a comment below telling me which type of fund you're currently invested in. I read every single one. See you in the next one.